In 1971, something unprecedented happened. The United States defaulted. Not officially, not publicly, but functionally. President Nixon closed the gold window, severing the dollars linked to gold, and essentially told the world, we're not paying what we owe. And nothing collapsed. In fact, the system got stronger. More debt, more growth, more power, concentrated in fewer hands. That should be impossible. Default should mean crisis, loss, restructuring. But it didn't. Because by 1971, the bankers had already built something remarkable, a system where default doesn't matter, where debt doesn't need to be repaid, where the very concept of owing money had been transformed into something else entirely, something permanent. Here's what they don't tell you in economics class. Debt isn't designed to be repaid anymore. It's designed to grow. And there are three specific mechanisms, three financial innovations created by bankers over the last century that made this possible. These aren't theories or conspiracies. They're documented changes to how money works. And once you understand them, you'll see why the United States can owe $38 trillion, why Japan can owe $9 trillion, why the entire planet can owe $315 trillion, and why none of it will ever be paid back. Not because governments are irresponsible, but because the system was deliberately constructed to make repayment impossible and unnecessary. Let me show you the three mechanisms, the bankers who built them, and why debt has become the foundation of the entire global economy. Because once you see it, you can't unsee it. Before 1913, when banks failed, they failed. Depositors lost money, creditors took losses, the market cleared. It was brutal, but it was finite. Debt that couldn't be serviced was written off, and the economy reset. Then came the Federal Reserve, and everything changed. The Federal Reserve was created in 1913, sold to the public as a stabilizing force, a way to prevent banking panics. And it does prevent panics, but not in the way most people think. The Fed doesn't prevent crises by making banks more responsible. It prevents crises by ensuring banks never have to face the consequences of bad loans. This is the lender of last resort function, and it's the first mechanism that made debt impossible to repay. Here's how it works. When a bank makes a loan, it creates money. You borrow $100,000 for a house, the bank doesn't take $100,000 from somewhere else and give it to you. It credits your account with $100,000 that didn't exist before. That's new money, created by the act of lending. Now you owe the bank $100,000 plus interest. But here's the problem. The interest wasn't created. Only the principal exists in the money supply. So if everyone tried to pay back their loans with interest, there wouldn't be enough money in existence to do it. The system requires perpetual new borrowing just to service existing debt. Now, normally, this would create a natural limit. Banks would eventually run out of depositors, run out of reserves, and lending would stop. But the Federal Reserve removed that limit. The Fed can create unlimited reserves, lend them to banks at nearly zero cost, and ensure that banks always have the capacity to make new loans. This means the money supply can expand infinitely as long as someone is willing to borrow. And who's the biggest borrower? The government. The U.S. Treasury issues bonds. The Federal Reserve buys them, creating new money to make the purchase. The government spends that money into the economy. And now the debt sits on the Fed's balance sheet. The Fed doesn't demand repayment. It doesn't need to. It simply holds the bonds, collects the interest, and when the bonds mature, the Treasury issues new bonds to replace them. This is called rolling over the debt, and it's been happening continuously since 1913. Benjamin Strong, the first chairman of the Federal Reserve Bank of New York, understood this perfectly. He was a protege of J.P. Morgan and one of the primary architects of the Federal Reserve System. In the 1920s, Strong pioneered open market operations, the mechanism where the Fed buys government bonds to inject money into the economy. This wasn't just monetary policy, it was a structural change. It meant the government could always borrow because the Fed would always buy. And it meant debt didn't need to be repaid, only refinanced. Strong died in 1928, just before the Great Depression, but his innovation survived. And it's the reason that today, the Federal Reserve holds over $5 trillion in U.S. government debt. That's debt that will never be repaid. It will be rolled over, refinanced, and held indefinitely. And the interest payments flow from taxpayers through the Treasury to the Fed, which remits most of it back to the Treasury, but keeps enough to fund its operations and pay dividends to member banks. It's a closed loop. The debt is permanent, the interest is perpetual, and repayment is unnecessary. Here's the second mechanism, and this one is even more powerful. In 1944, as World War II was ending, representatives from 44 nations gathered at Bretton Woods, New Hampshire, to redesign the global financial system. The British were exhausted, their empire crumbling. The Americans were ascendant, holding most of the world's gold. And one man, Harry Dexter White, the U.S. Treasury official who designed the American proposal, ensured that the dollar would become the center of global finance. The Bretton Woods Agreement established the dollar as the world's reserve currency. Every other currency would be pegged to the dollar, and the dollar would be convertible to gold at $35 per ounce. This gave the United States an extraordinary privilege. Other countries needed dollars to trade, to buy oil, to settle international debts, so they had to earn dollars through exports or borrow them from American banks. But the United States could simply print dollars. Now, this system was supposed to have a constraint. The U.S. promised to redeem dollars for gold. If America printed too many dollars, other countries could demand gold, and the system would self-correct. But Harry Dexter White understood something critical. By the time other countries realized the U.S. was printing more dollars than it had gold to back, they would be so dependent on the dollar system that they couldn't leave. Their reserves, their trade, their debts, all denominated in dollars. Walking away would mean economic collapse. And that's exactly what happened. Throughout the 1950s and 60s, the United States ran budget deficits, fought wars in Korea and Vietnam, and printed dollars to pay for it. Other countries, particularly France under Charles de Gaulle, started demanding gold. By 1971, the U.S. had printed far more dollars than it had gold. Nixon had a choice. Stop printing, accept austerity, let the domestic economy contract, or default on the gold promise. He chose default. On August 15, 1971, Nixon closed the gold window. Dollars would no longer be convertible to gold. The Bretton Woods system ended. But here's what's remarkable. The dollar remained the global reserve currency, not because it was backed by gold, but because the infrastructure was already in place. Oil was priced in dollars. International debt was denominated in dollars. Central banks held dollar reserves. And most importantly, U.S. Treasury bonds were considered the safest asset in the world, not because the debt would be repaid, but because the United States could always print more dollars to make interest payments. This is the second mechanism. The reserve currency privilege means the United States can borrow in its own currency. When Japan borrows, it owes yen. When Germany borrows, it owes euros. But when the United States borrows, it owes dollars, which it can print. This means U.S. debt is functionally different from every other country's debt. The U.S. cannot be forced to default because it controls the supply of the currency it owes. And this extends globally. Because the dollar is the reserve currency, when other countries borrow in dollars, they're borrowing something they can't create. If they can't earn enough dollars through trade, they have to keep borrowing to service the debt. This creates a permanent dollar shortage for most of the world, which means they must keep exporting to America, keep accumulating treasury bonds, and keep supporting the system, even though they know the debt will never be fully repaid. Harry Dexter White died in 1948, just 4 years after Bretton Woods, under mysterious circumstances during a Cold War espionage investigation. But his legacy is the architecture that allows the United States to run trillion-dollar deficits every year without consequence. The debt grows, but because the world needs dollars, demand for U.S. Treasury bonds remains strong. Repayment isn't necessary. The system is self-sustaining. Now, the first two mechanisms explain how governments can borrow indefinitely, but they don't explain why the debt keeps accelerating, why $38 trillion became inevitable. For that, you need to understand the third mechanism, financialization. And the architect of this system was Alan Greenspan, chairman of the Federal Reserve from 1987 to 2006. Greenspan didn't invent financialization, but he enabled it, encouraged it, and protected it. Financialization is the process by which debt stops being a liability and becomes an asset, a tradable commodity, collateral for more borrowing. It's the transformation of the entire economy into a debt creation machine. Here's how it works. In the old system, a bank made a mortgage loan and held it until you paid it off. The bank bore the risk. If you defaulted, the bank lost money. This created a natural limit on lending. Banks were cautious because they lived with the consequences. But in the 1980s and 90s, Wall Street developed a new model, securitization. Securitization means taking a bundle of loans, mortgages, car loans, credit card debt, packaging them together, and selling them as securities to investors. Now, the bank originates the loan, but immediately sells it. The risk transfers to whoever buys the security. And because the bank doesn't hold the risk, it can make more loans, riskier loans, because it's just going to sell them anyway. Greenspan loved this. He called it risk distribution. He argued that by spreading risk across the financial system, securitization made the system safer. But what it actually did was remove accountability and create infinite leverage. Here's the mechanism. A bank makes $1 million in mortgage loans. It bundles them into a mortgage-backed security and sells it to an investment fund for $1 million. Now the bank has its $1 million back, plus fees, and it can make another $1 million in loans. The investment fund holds the security, which pays interest from the mortgage payments. But the fund doesn't just hold it. It uses it as collateral to borrow more money. It pledges the security to a bank, borrows $900,000, and uses that to buy more securities. Now $1 million in underlying mortgages supports $1.9 million in financial assets. And it doesn't stop there. The bank that lent the $900,000 takes the mortgage-backed security as collateral and uses it to borrow from another institution. The same security gets pledged multiple times, creating a collateral chain. $1 million in actual mortgage debt generates 5, 10, sometimes 30 million in financial claims. This is called rehypothecation, and it was everywhere in the 2000s. Greenspan knew this was happening. He testified before Congress multiple times, and every time he defended the system. He said derivatives and securitization were making the financial system more resilient. He resisted regulation, resisted oversight, and when problems appeared, he cut interest rates to keep the debt growing. His philosophy was simple. More debt equals more growth. And if debt becomes unsustainable, the Fed will provide liquidity to prevent collapse.